I'd like to say that we're done talking about systems and processes, but not quite, because I think it's important for entrepreneurs, executives, and directors to appreciate the importance of policies and procedures. Policies and procedures often feel bureaucratic, and sometimes, quite frankly, they are. However, they exist for a reason, and a very important one. And that is to ensure integrity of the information and to safeguard the assets of the organization, as we begun talking about in our last lesson on accounting systems. Internal controls include such things as a requirement of managers to review and approve supplier invoices, a requirement of managers to review and approve employee expenses, limited access of different people to various modules of your IT systems, segregation of duties between the custody of assets and the record keeping, meaning that if you have access to the cash, you're also not recording it going into your bank, because then there's an opportunity for you to steal it. There are, or there should be, dozens, if not hundreds, of little checks and balances in place in every organization. Everything from making sure access to the bank account is restricted to making sure the office is locked at the end of each day. All of these little checks and balances exist to prevent and detect errors or fraud from happening. So while some of these policies and procedures may seem annoying, they are important and exist for your protection and that of your entire organization. When erroneous information is circulated or assets are stolen, the organization loses credibility and value. The single most important thing for you to watch for is the tone of the organization. When there is a strong controls-oriented management team at the top, this tone is more likely to be adopted by middle management all the way down to the employee level. The opposite is also true, unfortunately. A weak or even worse, corrupt tone at the top will often pollute levels below senior management. It's critically important to see senior management reinforcing the control environment by doing such things as following policies and procedures. If they don't like the policy or the procedure, then they should work with others to change it. But it's unacceptable to have senior managers that ignore or override policies, because it's setting that bad tone at the top. Staff should also be expected to follow policies and procedures, and when they aren't, accountability needs to be enforced. When mistakes are made, the root cause must be evaluated to determine whether there is a gap in either the system, process, or internal controls, and appropriate actions are taken. If you see anything else to the contrary, you should be questioning the leaders of the organization. Strong owners and directors will also assess the tone in the middle and the tone in the trenches, as we call it. There are a few ways you can see for yourself the strength of the internal control environment, even if you don't have direct access to these people. Do walkarounds and meet frontline staff as part of a plant tour. Inquire of human resources around complaints, safety violations, employee turnover, things like that. Establish a whistleblower hotline that gives employees an anonymous way to report misconduct. The importance of this internal control boils down to fraud. While we're on this topic of internal controls, we must talk about fraud. It's a topic few managers pay attention to. It's human nature to trust the people we've hired and worked with for years. But statistically speaking, this is an extremely naive view of the world. So as leaders, we need to pull our heads out of the sand and face facts based on the data. Fraud happens. It happens a lot. It's not a matter of if it happens, but preventing and detecting how and when it happens. And the data suggests this. Experts estimate that 5% of your organization's revenue is being lost to fraud every year. 5%! This is a staggering amount of lost revenues for most organizations. Most can't even believe it. But this comes from a biannual survey conducted by the Association of Certified Fraud Examiners. To put the 5% into context, what the experts have found is that the average loss suffered by an organization of the cases they've investigated is about $150,000. Now you may be thinking there's no way anyone would not detect $150,000 missing. Well, you need to bear in mind that the average duration of fraud happens over the course of 18 months, so less than $10,000 a month. That is a little harder for someone to pick up when it happens in small amounts over longer periods of time. When you think about fraud risk in your organization, you need to think broadly. There are more ways that fraud can be committed than you can possibly imagine. I don't say this to scare you, but to ignore it is far worse. So let me give you a quick sense of what you need to watch for and challenge management to address. Experts categorize fraud into 3 buckets. Number 1, asset misappropriation is the theft of assets. It's by far the most frequent and is composed of dozens and dozens and dozens of schemes. Everything from padding an employee expense report to employees skimming revenues before they get recorded on the books to theft of inventory. The losses are relatively less, but to one degree or another, most organizations have some sort of loss coming from asset misappropriation schemes. Number 2, corruption, which includes bribes, illegal gratuities, and extortion. Illegal gratuities are those tickets to the box at a game, trips, those types of things that are given to managers by suppliers trying to make sure that you buy from them, those types of things. These are harder to detect because these schemes tend to happen outside of the organization between employees and customers and suppliers. Watch out for employees with wheeler-dealer attitudes and overly close relationships with customers and or suppliers. And finally, we have financial reporting fraud, which is the least frequent but most costly form of fraud. This happens when executives and our finance people cook the books and misrepresent to you the true state of affairs. Why do they do it? Well, sometimes it's to earn a bonus or add fuel to a stock price. Other times, it's to keep a lender at bay. Many organizations have auditors who are an independent party who are brought into the business to look over the accounting records and the financial statements and express an opinion. But let's clarify their role by first stating that their primary responsibility is not to detect fraud. In fact, relying on your external auditors to detect fraud is one of the least effective ways to detect fraud. So if auditors aren't there to detect fraud, why do you even have them there? Many non-financial people wonder. An audit is performed to verify that the financial statements have integrity, not that the financial statements are precisely accurate, rather that they are not materially misstated. Auditors talk about materiality in the context of a notional amount that the numbers would have to be off by before users, we talked about in our first lesson, would change their financial decisions based on that information. Auditors use a few rules of thumb to quantify this concept of materiality. An easy one for you to remember is 1% of revenue or 1% of total assets. So if you have $30 million in revenue, that would suggest your materiality threshold is $300,000. In other words, that your financial statements are accurate within plus or minus $300,000. When compared to your average fraud of $150,000, that fraud would be quantitatively immaterial to an auditor and within their tolerance level for a misstatement. You can jump up and down and get all excited about this with your auditors, but it will be to no avail. You don't want auditors looking at every transaction that goes on in your business because audits are very expensive to conduct already and your auditors are well paid. So this is a trade-off that you just need to accept. The auditor's role is to express an independent opinion that the financial statements are fairly presented for the purposes of the decisions that you must make in your role and those of the other financial stakeholders must make, namely banks and lenders. With an understanding of the context of where financial information comes from and how you can then rely on it, in the next lesson, we will drill into the financial information before you.